Everyone, welcome to our discussion on CARS24 Financial Services and used car loan securitization. Let me start with a quick question for you. If thousands of people across India are paying monthly EMIs to their used cars, can these small loan payments be converted into investment opportunities for large bond investors? The answer is yes. And that's exactly what today's case explores. In this video, we'll explain how CARS24 transform used car loans into tradable bonds instrument called pass-through certificates, and why this structure is important for India's evolving debt market and what risk and return investors should evaluate.
Let's start with a simple idea. When you lend money and earn interest, you are basically acting like a bond investor. Now let's take an example. CARS24 gives out thousands of small used car loans to the customers. Instead of waiting years to collect the EMI, they bundle these loans together and sell them to investors. This process is nothing but securitization. The bonds created and pooled together are called as pass-through certificates or PTCs. So instead of relying on borrowers, investors receive money from hundreds and thousands of car loan EMIs, reducing the concentration risk.
Coming to the case itself, CARS24 is primarily known as the digital used car marketplace, but through its financial service arm, it also facilitates used car loans. So instead of holding these loans on the balance sheet for years, the company pools them and issue Asset-Backed Securities or ABS. These ABS are structured into the pass-through certificates, which are sold to investors in the Indian debt market. This approach has become increasingly relevant in India as NBFCs look for capital efficient funding options.
Now, let's apply our fixed income concepts. First, credit risk and probability of default. Since these are used car loans, the risk of borrower default is higher than that of housing finance loan. To manage this, loans are diversified, credit enhancements are issued, and senior tranches or senior investors, they get priority cash flows over junior investors.
Now, natural question arises here is, why securitized used car loans specifically? Used car loans are typically smaller, shorter terms and high yield than home loans, but they also carry high credit risk. Securitizations help spread that risk across many borrowers and make the asset class investable for institutions.
From a fixed income lens, the biggest concern is the credit risk. There is always a probability that some borrowers may default on their EMIs. To manage this, there are three important factors to take in account. First is loan diversification. Second is credit enhancement, and third is the priority payment to the PTC holders. This is why senior tranches are usually rated higher by the agencies like CRISIL and IRCA.
Another important concept here is prepayment risk. Borrower may repay loan early if they sell the car or refinance. For investor, this is similar to when the embedded option held by the borrower. Early repayment shortens the bond duration and can reduce the expected return. So, while yields look attractive, cash flow are uncertain and investor must price that risk.
In India, the securitization markets are tightly regulated. The Reserve Bank of India sets guidelines on maintaining minimum retention, disclosure and risk transfer. So this means that the interests of investors are always protected and ensures that originators like CARS24 Financial Services don't pass on poor quality loans. So this means that the regulations play a key role in maintaining trust in asset-backed securities markets.
Based on our analysis, our final recommendations are investors should focus on senior PTCs, issuers must maintain underwriting discipline, and lastly, regulators should continue monitoring retail loan securitization closely.
CARS24 used car loan securitization shows how everyday EMIs can become fixed income products, but only strong structure and regulation make them safe to invest in.